Thank you, Ryan. Okay. So these are the problem sets you should do. This is, again, just for the recording purposes, bond prices and risks, topic number 3. So we're going to start with talking about present value, future value, and compounding. I'm going to do an overvalue of bonds from a bond math perspective. Now, in this, I do start to introduce concepts tied to coupons, interest rates, and bond duration. My feeling on bond duration is that the better you understand it, the better off you are, which means we need to practice it over and over again. Probably won't get to that until next week, so we'll see. All right, present value, future value, compounding. For the sake of making sure that everyone is kind of comfortable with this concept, stop me. If you want to message me and say, go back, explain something, that's fine. But I am going to start with the basics. So the concept of present value, it's the value today of something in the future. And in the case for bonds, what's the value today for a cash flow that I'm going to be receiving in a year, in 2 years, in 10 years? And oftentimes in a classroom setting, I'll actually say, okay, if I were to offer you, let's say I'll give you $100 today or $200 next year. And anyone who wants to participate, just use the little show of hands button. Who would take $100 today instead of $200 in a year? Got a few people raising hands. Okay, put your hands down. Who would, instead of taking $100 today, who would wait to get $200 in 1 year? Anyone willing to wait to get that $200 in 1 year from today? No one. Oh, 1, 2, got a few people. Okay. All right, put your hands down. I'm going to do a case of behavioral finance or behavioral psychology here. I'll give you $100 million today or $100 million in 1 year. Who would say, give me the $100 million today? Okay. About 5, 6. Okay. 7. Put your hands down now if there's, okay. Who would wait, instead of getting $100 million today, who would wait for a year and get $200 million? A few people raising their hands. Okay, 2, 3, few people though. I would rather take a book on how to make 10 million. That'd be great too. All right, just out of curiosity, did anyone change their answer? Did anyone switch when I switched it from 100 to 200 or 100 million to 200 million? Yeah. So that's behavioral finance. When we change the zeros, we start to treat it differently, even though the return over that time period is the same. So there are lots of ways to explain why, and I understand. Okay. Now, at a certain point, if I kept on doing that for each one of you, given an almost unlimited amount of time, I would be able to figure out, well, what makes you indifferent? So if I were to say, $100 today, $100 today, $500 in a year, or $100 today, $103 in a year, what's the point where you would say, you know what, either one would be fine? Trying to figure out what your personal discount rate is. So if you're indifferent between $100 today and $103 in 1 year, your discount rate is 3%. 103 divided by 1.03 is 100. That's your discount rate. That is essentially all that bonds are. So let's just go through that. bonds are priced where we discount the series of cash flows by a discount rate. And for bonds, we call that the bond yield. And that's all that this is. So what's the present value of $100,000 cash that will be received in 8 years? So it's $100,000 worth of zero coupon bonds at a 3.5% discount, or 3.5% yield. So let's do that. 100,000 divided by 1.035 power 8. Close it up. $75,941. That's the present value. You do the same thing for different yields. 100,000 divided by 1.05 power 8. It's lower. That's a feature of bonds. The higher the yield, the lower the price. If you haven't heard it before, memorize it. If you've heard it before, make sure you remember it on your own. That's absolutely essential for bonds. Higher yield, lower price. They are inversely related. Lower yield, higher price. They go in opposite directions. And bond traders who are really, really good, like it's really clear to look at bid-ask spreads like I showed you before, but when you're presented bid-asks in yields, you have to flip it around. So for prices, you'll have to sell at the lower price and buy at the higher price. For yields, you'll have to sell at the higher yield and buy at the lower yield because it's inversely related to price when you're looking at bid asks. I'm not good at it. I can tell you that right now. If I'm not good at it, I'm not going to test you on whether you can figure that out. At least I don't think I will. I reserve the right to change my mind. So this is just showing different ways of how future value and present value work. It's important because when we get to bootstrapping, it's essential that you understand and are comfortable with this. We're going to do lots of bootstrapping examples because practice helps you understand. And if you haven't done a bootstrapping example before, it's not going to be fun. If you have done them before and you think that I'm being mean, this is how financial institutions hedge their interest rate risk exposure. They use products, combinations of products, actually essentially isolate different interest rate exposures and hedge them out and sell them. They sell contracts, they sell derivatives contracts to clients to help them manage their interest rate risk. One of the biggest client groups of large financial institutions is smaller financial institutions who want some help managing their interest rate risk. Okay, these are things that you can do on your own. Okay, any questions before I start talking about bonds? Anyone want me to go back and actually do those two examples? They should be pretty straightforward. If I don't hear or see anyone say so, I'm going to continue. All right, bonds. Bonds are just a big present value formula. Now, most of the time, I'm going to have you do annual pay, meaning one cash flow. If you use a financial calculator, you have to change the setting when it's annual pay so that it's annual pay, one pay period per year. And you'll have to change it back for semi-annual pay, which you will use in realistic settings. I do this because Those of you that don't have a financial calculator, you don't need to have it, and there's no loss of concept here. I'm still teaching you the concept just without making you do, oh, well, I got to unannualize. And you don't have to do that. So here's the formula. The price is equal to the discounted value of all the future cash flows. That's the coupon payment, discounted by the bond yield, plus the discounted value of the face value or par value, discounted by the bond yield. So K represents each annual period, and it goes from the first period to whatever the maturity is, the tenor. If it's 10 years, there are 10 coupon payments for an annual pay bond. And each time they're discounted by 1 plus Y. That's raised to the power of however many years into the future it's received. Face value would be F over 1 plus Y to the power 10 for a 10-year, discounted for the fact that it's received 10 years into the future. Bonds are almost always priced per 100. I cannot think of an exception where it is not priced per 100. Most bonds trade in increments of 1,000. In the United States, that's the convention. Different currency zones have different conventions. I believe that in India, it's something on the order of, oh gosh, forget, is it 20,000 rupees or something like that? It's multiples larger. Same thing with Japan. One domicile is very peculiar. Denmark is on the Danish kroner. I can't remember the exchange rate. It's probably something like 7 kroner per dollar or something. But you can buy in increments of 1/100th of a kroner, if I remember correctly, unless they've changed it. There are some bonds that are called private placement. That's when they are sold directly to an investor and are not really available for sale on the secondary markets. They have to be sold through a brokered transaction over the counter. And those are most commonly in increments of 2,000 or sometimes 5,000. And it's usually just 1 or 2 investors or a small handful of investors that are essentially buying up the entire issuance. Those of you that want to see what an actual semi-annual bond formula would look like, it's something like this. Now, I say something like this because this is exactly however many years from maturity, and it's on a 3360 day count basis because it's divided by 2, 180 divided by 360. In reality, we would have to look up, okay, well, what kind of bond is it? Is it a corporate bond or is it a treasury bond? What kind of day count convention do they use? Is the corporate bond issued in Europe? Because in Europe, they have a slightly different protocol for treating February 28th to March 1st or February 29th to March 1st. And it's always priced per 100, so the face value is 100. And we'll do some examples here in just a minute. But you'll notice here, K goes from 1 to 2 times T. K is the number of 6-month periods ahead, the number of half years ahead. T, capital T, still is how many years to maturity, but it's compounded semi-annually. So Y over 2, Y is always annualized, to the power 2T. If it's a 10-year instrument, Y over 2 is the semi-annual period yield unannualized. You have to raise it to the power 20 because 10 years is 26-month periods ahead of time. This is much more like what real bonds trade like. They use this formula. So back to annual pay, because like I said, I don't think there's any loss in conceptual understanding if we stick with annual pay. So price of bond, annual pay, coupon rate of 3.875%, exactly 3 years to maturity. That's important. Let me write this down so I have it when I pull up. $2.375 yield, 3-year. Okay. Assume 3360. That's so we can do something like this. Do not worry about weekday issues. So the bond can be paid on Saturdays, Sundays, and holidays. All right. Let's work this out. Coupon equals 3.875%. Yield equals 2.375%. Now, you can use Excel for this. I do use Lockdown browser for the exams, but I don't use the webcam. So you're not going to have Excel at your disposal. So using Excel is not going to help you. So in your quizzes, in your work, don't use Excel. If you're comfortable with using a financial calculator, you are welcome to do that. If you're not, when I take the exams myself, I do it longhand with a plain calculator, like the calculator you saw on my screen. So it has some scientific capabilities, but I do everything longhand and I time myself. So let's find out what the price is. Price is equal to first cash flow per 100. So the coupon is 3.875 divided by 1 plus the yield. Annual pay, I don't have to worry about dividing the yield by 2. 1.02375, I do that right? I hope. Power 1. Second cash flow, still 3.875, but I discount for 2 years into the future. Third interest payment, and the face value. Now notice something here. Those of you that like to do it this way, that's fine. Absolutely fine. I personally combine that last interest payment with the face value. They're both divided by the same number. You can combine them without any loss of accuracy. However, be mindful, if you do this, you're wrong. You will be wrong. So just make sure that you've got it all correct. 3 interest payments for a 3-year bond, and that final face value payment. This is still 3 interest payments. It's just that the face value and interest payment are combined into one fraction. Now we pull up the calculator. All right, 3.875 divided by 1.02375. 3.7851. Okay. 4 digits should be precise enough. I personally, whenever I have done this in my studies, I used to, at least for this type of problem, would at least go to 4 decimal points, sometimes 5. But I think usually, if you go to 4, you'll be fine. Okay. Now, because I already have divided by 1.02375, if I just divide again by 1.02375, that's the second term, 3.6973. You can type it in the longhand way to check to make sure that I did that correctly. Now, figure it out, 1.03.875 divided by 1.02375 to the third power equals 96.812. Now I simply add them up, plus 3.6973 plus 3.751 equals 104,260. Okay. Always, always, by convention, this is market convention, price per 100. Always. That's just the market convention. And I think consider yourselves fortunate we're not going to be doing foreign exchange products in here, because I missed the 8. Where? Second to last line. You're gonna have to, I don't know where I'm supposed to be going. Oh, when I put in the calculator. Ah. So minus. Is that right? Okay, thank you. 2944. Is that what you got? Okay, thank you. All right. We're going to price this bond at 2.5 years to maturity. No, I'm going to leave that to you, actually, because I want to do the semi-annual. Same bond. But instead of being annual, being semi-annual. And this will kind of show how it gets difficult. So first of all, we need to divide these by 2. So 3.875 divided by 2, 1.9375. just start there. So first of all, I have to divide the yield by 2. And this is now my coupon cash flow that is 6 months ahead of time. And I get it 1 6-month period from today. The second 6-month period, I get the same cash flow divided by 1 plus 0.02375 divided by 2. It's 2 6-month periods away. I'm going to run out of space soon. So I'm just going to do ... for now. So now I'm going to 0.02375 divided by 2 plus 1, 1.011875. And if you ever see that you're doing these along with me, which I highly recommend, just as you saw, I make mistakes with just entering in things when I'm doing it on the fly like this. Let me know. Try to double check every time. So 6 months, 12 months, 1 year, 1.5 years, 2 years, 2.5 years, 3 years. No, that's not right. There we go. Just want to make this fit on one line. There. Now it becomes a little more difficult. I'm still going to do it the longhand way. We'll see if I get it right this time. 1.9375 divided by 1.011875. It's a little faster when I'm doing this by paper. Going to 5 decimal points, just I have it. So since I've got that operation entered in here, just hitting equals gets me to the power 2 in the denominator. At least it should. Let's see if 0.9375. Yep. Since I started with 5 decimals, I'm going to continue with it. All right, anyone do this in a financial calculator and tell me if you got the same answer? Okay, great. So me doing this in front of you shows you how it's properly done for a semi-annual pay bond, but hopefully the tediousness of me doing it in front of you highlights how I think that this is overkill for me to try and test you to do it in a setting. I don't know if some of you, I don't know if there is 1 or 2 of you that don't have financial calculators and you don't want to buy one, that's fine, but that's why I do it annual pay. If you have just a regular calculator, annual pay works fine. Those of you that have financial calculators, remember, change the settings to be annual pay. If you're doing the present value as opposed to the bond feature in it, then that's, and you're comfortable with it, that's fine. Just make sure that you're using it the proper way to get you the correct answer. And I just personally prefer seeing the steps. It helps me understand. And so I'm doing this because for those of you that it does help, I want this to be there for you. Okay. So if you price these bonds at, for the one that's, go back up here, the annual pay bond, 2.5 years to maturity. If you price them using that formula, you are calculating what's called the inventory price or the dirty price of the bond. When you look at quotes in US bond markets, they are quoting something called the clean price of the bond. They take the inventory price, they subtract out any accrued interest. Those coupons are not paid every day, they're paid at set dates. And so it accrues on a daily basis. Therefore, if we subtract that out, we get the clean price. And if you think about it from an ownership perspective, for a semi-annual pay bond, let's say I bought it when it was issued three months ago, and now today I sell it. Who should keep that interest for that first 3 months? The person that I'm selling it to, or me? I held it for those 3 months. The ownership of that 3-month portion of interest should come to me. In most bond markets in continental Europe, I think it is still the case that they quote using the inventory price. Using that formula on the prior slide will always give you the inventory price. On the first day of trading, so the issued date, or on the coupon payment date, The inventory price is the same as the clean price, but only on those dates. So however many coupon payment dates there are in the bond's life, those are the dates where the price is the same, the clean price is the same as the inventory price. Why do we go through the trouble of removing accrued interest? Here's why. The formula we had on that prior slide gives you this light blue line. And you can see very clearly payment date. These are annual pay. Makes it more pronounced. September 2019 payment date. The interest accrues September 2020 payment date. Interest accrues September 2021. Well, that's the maturity of the bond. There are a few other things I want to point out here. Clean price is that dark blue line. By subtracting the accrued interest, we get rid of these zigzags. There isn't a sudden drop on the coupon payment date. Another feature about bonds, if nothing else changes, the yield doesn't change, the only thing that changes is passage of time, there's something that's called a pull to par. This bond is trading at a premium. That means that its coupon is higher than the market yield. The market yield is below the coupon. So it's trading at a premium. Over the life of this bond, so long as nothing else changes, like the yield doesn't change, the price of the bond, the clean price, gets pulled to par. So it goes down. If this were trading at a discount, so the bond yield is higher than the coupon rate, it would trade up because it's trading at a discount below 100 per 100 par. So it'd be trading at, say, 96 for every 100 of par. As time passes, that clean price gets pulled up to the par value of the bond. That's generally true. It's called the roll. As you roll down the yield curve, get pulled closer towards maturity, pulls to par. Now, another feature that pulls it to par even faster is that as you get closer to maturity, the comparable yield for a shorter term instrument typically goes down. And that further accelerates the pull to par, especially for a premium bond. So this is an exercise which I'll probably do. Does anyone want me to go through this in front of you now, as opposed to me letting you do this on your own and asking me questions later to go through it? Does anyone want me to do this now? I don't see anyone saying yes. So I'm going to leave this to you to do as an exercise. I'm happy to walk through it in office hours on Tuesday or at the beginning of class next week. But this is something that you should do. What's the main difference between this and the regular annual pay? Okay. So based on the last two comments, I'm just going to go ahead and do this in front of you now. And then we'll end class. Actually, I think this will probably take up the remaining time. All right. So this is an annual pay bond. Now, the way that I've formulated this in this summation, you do not have to do the summation notation. I do it because that's the way I'm used to doing it. Price the annual pay coupon bond from before, where it's got 2.5 years to maturity. So 3.875% coupon, 2.375% yield, but it's 2.5 years to maturity. So let's get that information up here. All right, let me see if I can do just a quick infographic here. Okay, 2.5 years to maturity. Okay, let's see. That's 0.5 years from now. 6 months. 1.5 years. 2.5 years. Today. Okay. Pay the price today, and in 6 months' time, you get 3.875. In 1.5 years, you get 3.875. 2.5 years, you get par value, so 103.875. Are we all good so far? So our formula from before needs to be modified because that first cash flow is in half of a year. So this needs to be 0.5. Second cash flow is in 1.5 years, 1.5. The last cash flows are in exactly 2.5 years, 2.5. Okay, let's pull up that calculator. 3.875 divided by 1.02375 to the power 0.5. 3.82, that's covering up my number, so I can't see it. There we go. There's a little menu drop down when I put my cursor too high up. 3.8. I'm going to call that 30. Oh, sorry. 298. Four decimals. 8298. I think 4 decimals is probably good. Yeah. So this makes sense written out. It's summation notation you have to get used to if you're going to use it, but you don't have to use it. Those of you that are interested in writing things into like a compiler, algorithmically writing something, it's a lot more, it's better to understand the summation notation because that's how you're going to write your code. Okay, so divide this, let's just all clear it out. 3.875 divided by 1.02375 power 1.5, those are the parentheses, equals 3.7409. How would you key in those half years in the calculator? See, does your calculator have a button like this, x to the power y? If you don't have a financial calculator, you need to have x to the power y. So let's see. Let's do this last one. And you tell me if your calculator has that. The calculator that's provided in the Canvas platform should have that as well. Using the TVM solver. So there's a trick you can do. Give me a minute, and I'll see if I can come up with a different trick for you. Okay. All right. 103.875 divided by 1.02375 power 2.5, close up the parentheses, equals 97.9509 plus 3.7409 plus 3.8298. Is someone checking my work here? $105.5. I'll leave it at 526. Close enough. All right, so here's a trick that you can do. See if this will work. You have 1 over 1.02375 to the power 1/2 times these terms here. So you now have an extra step to do. You have a 3.875 interest payment, annual pay, 2 years, with a final payment of an additional $100. So this is a 2-year for maturity bond, 3.875% coupon, 2.375% yield. You can solve for that using your, what's the TVM, is that what you called it? Time value of money. You can solve for that, then add 3.875, then divide it by this 1.02375 raised to the power 1/2. And so that's a workaround you can use if you don't know how to trick your calculator into doing this, because really that's what it all is, tricking your calculator to do what you want it to do. So just remember though, when you enter it into their calculator using the TVM, you're calculating that part. Don't forget to add the first coupon payment before you divide it again by this 1.02375 to the power 1/2. All right, this is the inventory price. What is the accrued interest? Yeah, Hussein's got a point. You can double the period and have the yield and the coupon payment. Actually, I don't know. Hussein, is that true?
I'm sorry, could you repeat the question?
your comment, you can double the period and have the yield and coupon payment. I don't know if that works out. Can you try it?
That's what I've been doing, and so far it's been working out.
Okay. Just be careful because I'm concerned whether or not that actually works. I mean, in the multiple choice, you probably will get close enough, but I don't know if it will be as accurate.
Okay, I'm using two calculators anyway, just to double check. I'm
Okay,
using gear
that's
method
good.
and then doing the TVM method.
Okay, I just want to make sure that because I do know that anyone who's in the class that's interested in the CFA program, when it's only multiple choice for the multiple choice ones, they only have 3 options, and they choose distractors that you would very likely get. You know, most exams are going to have a 1 or 2 distractor answers that are obviously wrong, and you can throw them away. But for the CFA Institute, their exams, if that actually does in fact yield a slightly different answer than what they would actually be doing or wanting you to do, they might have that answer on there as well.
Mm-hmm.
So I just want to, just to make sure that everyone's warned about if anyone who's thinking about taking the CFA exams, those exams are very hard, and they only have 3 options for their multiple choice answers. And they design them to be hard and tricky. So if that works and it gets close, great. Just be sure to double check it. All right. The accrued interest. So there are 5 years left, or sorry, excuse me, there's half a year left between today and that first interest payment. It's an annual pay. That means looking backwards, there's half a year behind me. So I look at just copy that whole thing. Is that correct? Arithmetically, 3.875 divided by 2. Right? I think that's correct. So those of you that are using a financial calculator, there is typically a bond price function. I believe that the default setting is the bond price function delivers the clean price. So if you're using the TVM, that's going to deliver the inventory price, I think, or maybe not quite, because it's equal. So the bond price, let me try and find my calculator here. I used the Texas Instruments one. And if you go down below, let's see, it's on mine, it's just the BA2 plus. Above the 9 key, the 9 button, is the second option is bond. And if you have the, I've forgotten how to use it. Surprisingly, it's been that long. But in the instructions, it tells you how to use that to deliver the clean price. And then you can also deliver the accrued interest using the calculator. But figuring out the accrued interest is not, it takes a little bit of practice. Once you get used to it, it should not be too difficult. I'm going to do one last thing, and I'm holding you late. Actually, I'm going to leave this to you to do. I want you to figure out the accrued interest. You don't have to do the clean or dirty price again. Figure out the accrued interest if this bond were (2 years and 3 months, 2 years and 2 quarters months, and 1 quarter month, 2 and 1 quarter years, excuse me, 2 years, 3 months, 2.25 years. And I can start with that next time. But find the accrued interest if it is 2.25 years from maturity. I highly recommend that you figure that out. So, any questions before we close up here? I know I went a little late tonight. Okay. Office hours, again, Tuesdays, 8:30 to 9:30. And if anything comes up there that I think really needs to be talked about again in class, I will. And then also, if you have any questions for next week, just make sure that you ask them, whether it's send me an email, send me a message in the chat, or I absolutely welcome you to talk. It gives me a chance to hear someone else's voice. So, all right, have a good evening, and I'll see you next week.
Thanks, Professor.
Thank you.
Thank you.